Welcome to Retirement Income Planning, the Insurance Edge. Here are the four biggest risks that retirees face today. I want to primarily focus on longevity risk and withdrawal rate risk for the next few minutes. Now, most experts would agree that the number one concern of retirees is running out of money. According to an article in usatoday.com in October of 2013, more than 50% of retirees said that they're worried that they will outlive their retirement savings. As we move forward in our discussion today, please keep in mind that the only financial professional that can offer a guaranteed paycheck for life is the insurance agent. So when you start to think about planning your retirement, how much you're going to need, how much you need to save, when you're going to be able to retire, most retirees will turn to one of three resources for help. The most common is the investment broker. Here we're using a traditional approach. It usually involves rebalancing an investment portfolio in order to reduce risk, and then using a safe withdrawal rate so that our portfolio will last for as long as we do. The second commonly used advisor is the banker. Of course, here we're typically talking about an interest-only approach. We're relying on safe financial vehicles with zero market risk, and most folks that use this strategy live off of the interest and want to preserve their principal. The third most common consult is with an insurance agent and what we refer to as the insurance option. In the insurance option, we're seeking to provide guaranteed income for life. And the common solution is an immediate annuity or a fixed index annuity with an income rider, keeping in mind that only an insurance agent can provide this. I want to take a look at a hypothetical example and compare these three retirement plan options, both from a distribution phase and then for an accumulation phase first, and then in a distribution phase. For our case study, let's consider that Susan, who had a retired savings balance 10 years ago of $300,000, and let's look at these three different methodologies, and let's ask what would her savings balance be today. If we look at the traditional approach first for accumulation, to illustrate our point, we're going to keep it very simple. We've completely ignored any fees, dividends, taxes. We've simply assumed in our example that Susan's portfolio matched the S&P 500 index's results exactly over the last 10 years. Now, while the S&P 500 hit some record marks over the last 10 years and is currently at record highs, we also saw significant downs, particularly in 2008. Many mutual fund managers didn't match the S&P, and most average investors did much worse. So if Susan matched the S&P 500 exactly, she would have done well, and her retirement savings portfolio would be worth $492,226 today. Now let's take a look at the more conservative approach, using certificates of deposit as our accumulation vehicle over that same 10-year history. This assumes Susan chose 5-year CDs. The average 5-year CD 10 years ago earned around 3.85%, and it could have renewed in 2008 at around 4.4%. Now those sound like great rates today, and based on these rates, which were in effect over the past 10 years, our client or Susan's retirement savings balance today would be $442,182. Now let's take a look at the insurance option. Had Susan put her money in a fixed index annuity, she would have participated in the upside of the market up to a cap, and she would never lose value due to market declines. The example here assumes a fixed index annuity with a 10% bonus and a 6.5% cap. And now, in case you're wondering, this is a real product, and we're being conservative because the caps were considerably higher than 6.5% back in 2003. With the insurance option, Susan would have a retirement savings balance today of $554,414. Let's take a look side by side at the savings balance generated from these three accumulation alternatives. This result is probably not what most folks would expect. But remember, now we're going to be entering the distribution phase. We're now entering retirement. For the past 10 years, we've been in the accumulation phase. The question is, on Susan's mind, she is most concerned with is not about average return, but how much money can she safely withdraw each year to live off of. And so we have to ask the question, what is a safe withdrawal rate? Let's talk about safe withdrawal rates for a moment and do a little history lesson. First of all, let's define a safe withdrawal rate. It's simply the amount of money that you can withdraw from your investments each year, accounting for inflation, with a high likelihood that the money will last for the rest of your life, even if the investments are delivering below average returns. Historically, the accepted rule has been a 4% withdrawal rate from a balanced portfolio. It's interesting that in a study that was done in 2008 by MetLife, 43% of boomers believe that they could withdraw 10% of their retirement savings each year. Houston, we have a problem. There is definitely a disconnect. Now, obviously, this study was probably done prior to the crash in 2008. The results otherwise might have been different. In 2011, the Wall Street Journal published an article entitled "Say Goodbye to the 4% Rule." They provided their opinion that today 2% is now the bulletproof withdrawal rate, although in the article they indicated that 3% was still considered to be relatively safe. Along the same lines, a December 2011 article in the Journal of Financial Planning suggested that the truly safe withdrawal rate was 2.52%. So, let's go back now and let's take a look. As you will remember, with the traditional investment approach, Susan's retirement savings balance grew to $492,226. If we use 3% adjusted for inflation as the safe withdrawal rate, Susan can take annual income of $14,767 per year from her balanced portfolio with a reasonable expectation that her money will last for the rest of her lifetime. Now note, we've used the safe withdrawal rate of 3%, not the bulletproof rate, which was 2.52%. The expectation is that the savings will last as long as Susan does. If the market performs very positively in the future, she could do better. However, if the market performs worse than expected or Susan lives way past normal life expectancy, she could run out of money. This strategy is based on reasonable assumptions, but cannot give Susan a guarantee that she won't run out of money. Now let's take a look at the interest-only method of distribution. What does a 5-year CD earn nowadays? Well, we all know it's not much. In fact, the best rate that we could find at the time of this publication was 2.02% from an online credit union. This would generate an interest-only annual withdrawal of $8,932. That distribution, of course, is level for 5 years. And the good news is that the rates could go up in the future and the principal is guaranteed. Finally, let's take a look at the insurance option during the distribution phase. Now, we didn't discuss this earlier, but with most fixed index annuities sold today, Susan has the option to purchase a lifetime income benefit rider. The annuity we used in this example has an income rider that at issue guaranteed a 7.2% compounded roll-up on the income account. You can see that we have adjusted the cash value of our FIA to $517,780, which now reflects the cost of the rider. We've added the lifetime income benefit, which guarantees an income base of $661,396, and the income base is simply the premium plus the bonus, growing at a guaranteed roll-up rate. Today it's worth $661,396, and it will guarantee Susan $33,069 per year of income for as long as she is living, even if she spends down all of her cash value. That's a guaranteed paycheck for life. So let's review them side by side. First, the traditional method, remember, yielded $492,226 in retirement savings, which will generate an initial retirement paycheck of $14,767, and this amount will be increased each year by inflation, so that's a good thing. There's growth potential if the stock market performs well. The flip side of that is that Susan could run out of money. This result is based on conservative estimates, not guarantees. Now, the interest-only retirement savings are only a little less than the traditional method, but the challenge of this plan is that the income generated is very low at $8,932 a year. This method preserves the principal, and rates could go higher in the future. The insurance option is clearly the best, not only for accumulation, but also for guaranteed income that will last for a lifetime. The income is guaranteed to continue for life, even if the cash values run out. The insurance choice also provides a range of options, which include things like joint payouts, inflation-adjusted payouts, or the option to allocate a portion of the income to fund other things such as life insurance, long-term care, etc., etc. Another way to compare the three methods is by taking a look at the amount of retirement savings that would be required to generate the same amount of guaranteed income as the insurance option. The traditional method would require $1.1 million or 224% more savings to match the insurance option, and the interest-only method would require a savings balance of $1.6 million or 370% more. You know, baby boomers need you. They need incomes that last for life. They need to withdraw more than 2 or 3% and be guaranteed not to run out of income. Most want upside potential, but what they don't want is the risk associated with it, especially in retirement. They want protection against potential chronic care costs, but many are looking for alternatives because they don't want to lose the premiums they pay for long-term care if they don't need it. We all know that insurance products provide solutions for all of these concerns. I'd like for you to know that we have a consumer-approved version of this presentation that is available in a PowerPoint with the script. We also have a narrated version that you can watch with your client. If you would like to receive the approved consumer presentation version, please give us a call, and I want to thank you for taking time to view this training video.